Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Torsten Slok of Apollo saying 10 tailwinds are increasing the likelihood that the Fed will have to reverse course at its November meeting. In short, the no landing continues. Torsten's with us around the table. Torsten, good morning.
Morning.
When you say reverse course, do you mean pause or start going the other way?
I mean pause.
You mean pause?
Yeah.
Okay, share the 10 tailwinds with us.
Well, so the key tailwinds, of course...
Not a memory test, pick 5.
Okay.
I was about to
a lot of things that are supported for, of course. First of all, most importantly, when the Fed turns dovish, financial conditions begin to ease. This has been a very strong tailwind just in the last few weeks since the September meeting. Second of all, underlying the growth outlook, we also have the CHIPS Act, the Inflation Reduction Act, the Infrastructure Act. Those are also very strong tailwinds that continue to provide support to construction of manufacturing facilities. We also have on top of that a lot of spending on data centers, on AI. I have not met anyone who is saying, oh, I'm not going to build a data center because the Fed just raised 25 basis points. On the contrary, this is a structural force. It doesn't matter what interest rates are doing. At the same time, we also have at the highest level, stock markets are rallying, credit markets are very tight, and at the same time, consumers are still very strong. So overall, the tailwinds in the form of what will the outlook look like for the next several quarters just continues to not be surprising why we're getting still 254,000 jobs, why GDP growth in the second quarter was 3%, and Atlanta Fed GDP now for the third quarter is 3.4. I mean, you really do begin to ask the question, where is the slowdown? And as we have been debating before, is monetary policy really restrictive? If it is so restrictive, why is the economy still doing so well?
They don't just believe it's restrictive, they believe it's sufficiently restrictive to get inflation back down to 2% over a certain period of time. Do you have your doubts then?
So, well, it becomes a bit of a semantics of what exactly does it mean, because it was for a long time the argument that when the Fed funds rate is where it is at the moment at 5%, and if we are supposed to go to our star, which is 3%, that must imply, if you have that model in your mind, that we have very restrictive policy. But the incoming data across the board, if you look at the daily data on your Bloomberg screen for how many people go to restaurants is still very strong, how many people fly in airplanes, daily data also very strong, debit card spending on my Bloomberg terminal, also daily data very strong, weekly data for retail sales strong, the number of people who are at the moment spending across basically most categories of consumption, as we saw in the retail sales report last week, also very strong. So in that sense, it's not even the case that there was a slowdown last week. It's still the case that things are still chugging along very nicely.
That said, you are seeing in surveys and talking to different executives that they're not really planning on hiring mass groups of people, that they're actually allowing attrition to shrink their workforces. You are seeing signs that there is sort of evening out in the labor front, and that seems to be the big concern for the Federal Reserve that sees that as a slower moving ship. Why do you think that isn't enough to really create a landing?
Well, if you look at the Challenger Gray and Christmas survey of the announced job cuts, that's still very low. This is a monthly series where they go out and ask companies, are you planning to do mass layoffs? And the answer to that at the moment is there's no increase in mass layoffs. In the JOLT survey, the layoff rate, meaning the percentage of people who lose their jobs, is at 1%. So total employment in the US is about 160 million people have a job. So the layoff rate means that 1% get involuntarily fired every month. So that's 1.6 million people. But that's been very flat for the last 2 years. There's no increase in the layoff rate. So in that sense, yes, there's a lot of worries, and there's certainly a lot of things on the horizon, including election, geopolitical risk, other things you can begin to think about. But the bottom line still is that the incoming data, it just continues to show that the economy is doing just fine. Jobless claims, we had some hurricane issues, but look at the next non-farm payrolls report. If we do get that at 150 or 200,000, we could easily get a scenario where the Fed will basically have to reverse course and begin to stay on hold.
Are you saying that you're completely discounting the next jobs report that we get?
So I will say that I think the pain trade for the market is that if it's a lot better, because everyone is expecting it to be bad now. So that's why if everyone expects it to be bad, then well, that could either be the economy slowing down or it could be the hurricanes. But imagine if that comes in at 150 or 200, then I think the market will say, whoa, maybe things are not that bad. So I think taking the totality of the data, the mosaic of what's going on in the incoming data, it still tells me that we are in the no landing scenario. It's just really difficult to argue that monetary policy is restrictive.
How many more months of this do you need for the Federal Reserve to come round to your view of the world? Is November 7th too early?
So I do think that the next employment report obviously is very important, but I think that everyone is expecting it now to be bad. So that's why I think it will not take much more than a little bit better than expected employment report.
What is bad, by the way? Because you said 150 might be sort of the pain trade.
Well, as you know from Tara Watson and Andy Whittleberg at the Hamilton Institute at Brookings, they have been quantifying what is the level of employment growth now we've had so much immigration. And their estimates have said, well, we should be more like 200,000. Now the question is, well, if we do get 150, well, that will certainly be below that. But if you're correct for hurricanes and all the other things that are holding things down, well, then I would say a good report would certainly be even something at 150. Bad would be below 100,000. But at the moment, again, the totality of the data that comes in, it completely justifies both why Fed's pricing is changing and also why long rates are going up.
John asked a question about potential reinflation, which I think is a really important one, because even as people see all of this robustness, they still see prices on a year-over-year basis continuing to come down, and that alone is enough to justify some of the Fed moves. When you take a look at the panoply of potential policy that we could potentially get, when you start talking about manufacturing more in the U.S., when you start talking about tax cuts, how much does that actually feed into inflation? What are your models looking at?
Well, what's most important is what is the fiscal impetus? In other words, how much does it support GDP? And of course, if you look at it from the broader perspective, the Trump tax cuts that are running out by late 2025 become very important in that discussion. But that's still quite some time away, only in 2026. So the story here and now is still in the very near term that we still have tailwinds from the fundamental reasons why the economy continues to do so well. But to your question, Lisa, what really becomes important for inflation is that if this easing that now is being signaled by the Fed begins to mean that we still have more job growth, we still have more wage growth, which are very important drivers of housing demand, that means that the 40% of the CPI basket that is housing, if that begins to reaccelerate, then we could have the risk that inflation begins to move higher again. So that's why we're watching very, very carefully what's going on in the housing market at the moment, because there's already a number of indicators suggesting some more signs of life, which could potentially begin to be that problem that inflation could begin to move higher because of housing inflation moving higher.
Is that just a vicious cycle? Basically, people think the Fed's going to cut more, so they start to potentially look at maybe getting on the property ladder, maybe going out and getting construction done on their homes?
Well, the Fed has since December been signaling that now rates are going down. The pivot in December of last year was certainly after having said for several years rates are going up, 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 to now say rates are going down. And at the same time, the key drivers of housing demand, of course, are three things. Mortgage rates, of course, they are a little bit up now again, but the two other key factors are wage and income growth, and at the same time, job growth. And wage growth and job growth still doing fine. So it's not surprising that we're seeing the housing indicators begin to show more signs of life.
Let's talk about fiscal policy. You see in the bond market today, some people coming on this program saying this is down to a Trump trade. Do you believe that?
Well, if you look at your Bloomberg screen at the term premium, both from the San Francisco Fed by Jens Christensen and also the New York Fed term premium, they have been going up quite a lot. And when did it start to go up? It started going up exactly after the last employment report. So in that sense, I would say that most of the rise in the term premium we're seeing here, meaning most of the rise of why is it that people are now betting higher rates to go up and why is the yield curve steepening, is because of this issue that people are looking at it from that the business cycle is simply a lot stronger than what we thought before. So that's probably a lot of people that are squeezed out of the short view, meaning that the economy is going down and maybe it's now not going down and therefore rates have to go up. But there's probably also a lot of people that are beginning to come to the conclusion that, hey, maybe monetary policy is not as restrictive as the Fed has been saying and as the market has been telling itself for quite some time.
Torsten, in your scenario, your look at the world as it is, does that mean that where rates are, even if they go to 4.5% on the 10-year, you could see a sustainable rally in equities, that essentially this is a less bond-sensitive equity market than a lot of people think?
Well, I do still think that corporate earnings are actually still doing quite well. What really is the key issue for investors this year is that if the yield level is higher, that means that private credit will continue to give you higher yields, fixed income will continue to give you higher yields, and for investors and asset allocation, the key message is we are not going back to zero. So therefore, capital structures that were put in place when interest rates were zero will continue to be vulnerable, or put in different words, companies that have earnings continue to be attractive, both on the debt and on the equity side. And the reason why that's important is that also means for equities that this discussion about small cap relative to large cap will continue to dominate the debate in the equity space, because small cap will continue to be vulnerable if rates are higher for longer. Because again, if I have a company with no revenue, no cash flow, no earnings, of course when my debt servicing costs go up and stay higher for longer, of course I'm going to get in trouble before other companies that actually have earnings. So that's why it is all about investing in companies that have earnings and looking at it both on the debt and equity side. And that's why those parts of the equity and private equity world where you invest in companies with earnings will generally tend to do a lot better.
Torsten, this was a clinic. It always is. We appreciate it. We've had a healthy debate over the last few months on this topic, and the data's moving your way. That's for sure. Torsten Slok there of Apollo. Brent Schutte of Northwestern Mutual saying this: well, it may be months before we know if the Fed is able to cut rates fast enough to resuscitate weak areas of the economy. The bifurcated nature of the economy brings with it risk. Put simply, there is less room for error when only a fraction of the economy is healthy. Brent joins us now for more. Brent, welcome back to the program. Last time we had this conversation, we were debating whether this Fed is too late. There are people around this table now saying that maybe this Fed was too early. What do you say back to them?
I think that highlights the difficult path going forward for the Fed. Look, investors are way too optimistic that the Fed is going to cut rates in a nice, neat, and tidy way. There is the possibility they cut rates too quickly, the possibility they cut rates too late. They don't know, we don't know, and I think that's where the risks are, is that there is the chance that the Fed has cut too early already and that inflation pressures are coming back. The narrative was the Fed would cut rates, everything would be well, and it would alleviate the interest pain on certain parts of the economy. Well, the Fed cut rates in the 10-year Treasury 60 basis points higher, which has pushed mortgage rates higher, which has made housing more unaffordable for most every American in the country.
So, Brent, bad if you want to buy a house. Where does it leave the equity market? You were cautious last time around. You were cautious on large caps, I believe. Slightly more bullish on smalls. Has that changed?
No, that's the irony. I mean, you've had a bifurcated economy in a bifurcated market. At some point, we have to get back to equilibrium. How do we do that longer term, I think, is the question, and do we need a recession to do it, which historically has been the way that you've got an economy back into equilibrium. I think the irony is there's opportunities in small and mid caps because, yes, they are interest rate sensitive. Who doesn't know that? I could say stay in quality for a while and it could continue to work. But think about the other side. What happened in July when we thought the other side was coming? There was a ferocious rally in small and mid, which are historically cheap. And that's where I think any investor should think about right now, given that uncertainty, look to valuations, which tend to matter more over the intermediate time period as your guiding light and guiding post. And that's where we're positioned right now.
Brent, I'm trying to put these two things together, and I'm a little bit confused because if there is this risk of a no landing and inflation being stickier than expected, and frankly, longer-term yields rising if the Fed cuts more, why go into the more interest rate sensitive stocks that actually hinge and do better when you get more Fed rate cuts, which don't seem like they'd be in the offing given some of the better than expected data and the performance that we've seen in bonds so far?
Look, at the end of the day, the Fed knows how to get inflation down. It knows how to kind of stem inflation overall. We saw what had to happen back in the 80s. To me, it's always about what happens next in market and what's not priced. If you look at 1999-2000, which I think is a perfect example for where we're at when the market was concentrated and we were in economic cycle over time, you actually saw small and mid do better into that recession and thereafter because they had already priced in the fact that it was likely we were going to have a recession. And that's where I think we're at right now. And that's where I think thinking beyond the next 3, 6, and 9 months and thinking out to the next 2, 3, 5 years, that's where I want to be positioned because no one's thinking that way any longer.
One thing that you point out is, and you keep saying, is valuations. And that's one of the main drivers for you right now, given how high valuations are, particularly in large caps. That's the area you like least. Why is the argument not valid with, say, investment-grade bonds where spreads are pretty tight and valuations are pretty full also?
It is. I mean, look, I agree longer-term interest rates are likely to be higher, but I think the path is lower at some point just because I do think you're going to have a recession to kind of clear the deck of all the abnormalities that are out in the economy where you have the haves that are winning quite a bit and the have-nots that are not. This is where I think we want to be more towards treasury debt, even though I do see longer-term risks there. I think there will be a flight to quality much like there was back in July, believe it or not. And that's where I think we want to be positioned more so not so much out on high yield. I think investment grade high quality is still a place to be as you think about the reality that the Fed will only be able to cut rates aggressively if they do see a recession on the horizon.
Brent, we're 14 days out from the U.S. election, so I have to ask about how you're your advice for positioning ahead of that. You like the small caps. Do you think that is a Trump trade that's on right now because of policy or because of economics?
I think it's a bit of each. Look, I don't want to overweight the election too much. I don't think anyone knows what the outcome's likely to be. And therefore, if I don't know what the outcome's going to be, I don't try to position too much for it. It certainly is in the background. I think the more important thing is the economic cycle, which I keep coming back to. Look, we are later in an economic cycle. Yes, the unemployment rate has risen, but it's still low. Where are we going to find the people to fill the supply that is needed if demand reaccelerates? And to me, that's where I think that's the most important thing. And no matter who wins, I think they are likely to preside over a recession in the next 4 years. And I think they're likely to preside over a market, especially large cap stocks that are historically expensive, that does less. That's where I think investors should be optimistic on the other side, where things are cheaper and will do better, I think, when we get to the other side of whatever lies ahead.
Get to the other side. Yeah, we're all looking forward to getting to the other side. When it comes to, though, this idea of potentially your recession call, could potentially the policy of whatever administration we get next further push the U.S. in that direction? Or do you think that is going to happen regardless?
I think it's likely to happen regardless. Look, you have a really unbalanced economy that has been demarcated by interest rates and ownership of financial assets. It's not balanced. The economy is being pushed higher by higher income and middle income consumers who have had a wealth effect at their tails. If you have debt and you don't own a house, you probably don't feel as confident about what's going to happen going forward. And so to me, I do think there are still risks that are out there, and that's all we're asking is that investors pay attention to those risks and importantly stay diversified, which does tend to pay off at the end of economic cycles, which I think is still out there on the horizon.
Brent, what it sounds like to me is that in some ways you agree with this call that we heard from Goldman Sachs and that Cameron Dawson over at New Edge seemed to agree with, that equity returns on the large caps are probably pretty muted over the next decade or so. And so you're basically trying to shift things around on a valuation basis with that expectation that there isn't going to be some sort of massive acceleration. Is that correct?
100%. I mean, to me, valuation does tend to matter. It does not matter in the short term. It's an imperfect timing tool. But I think about the regime change that's likely to occur. Look, every economic cycle back to the 80s has had new market leadership. And the prior leaders have become the next cycle's laggards because the economy changes and those asset classes are typically priced for perfection at the end. And that's where I think we're at. And how do you transition from what worked in the past cycle to what we think will work in the future? That's the difficulty of trying to explain the positioning that we have. It's just that at the end of the day, valuation does tend to matter. I don't think valuation is dead. I hear that argument. I've been doing this for 30 years. It typically gets loudest at the end of an economic cycle where people are really tempted to concentrate in yesteryear's winners. Eventually that becomes a losing strategy, and that's why I want investors to stay diversified, stay true to their plan, and think about the reality that asset classes don't die, they just go to sleep for a while. And that's where I think there'll be new winners on the opposite side of whatever comes in the next few months.
This was thoughtful. Brent, we appreciate it. Thank you, sir. Brent Schutte there of Northwestern Mutual. Reiman of UBS assigning a 45% chance Harris wins with a split Congress, writing a Democratic sweep would likely be the most negative outcome for equities. Markets would likely cheer a Republican sweep for its lower taxes and lighter regulation. But this could be partially offset by concerns about the costs and inflation impacts. I'm pleased to say that in the studio, Kurt joins us now. Kurt, good morning to you.
It's good to be with you.
You are in a fantastic seat because you sit on both the fixed income side of things, and you have to deal with the politics in this election over the next few weeks. Can you tell us how much of an election impact you think we're already seeing in fixed income?
I think there may be some of an impact because it's not just happening in the bond market. You're seeing it in some of the sectors within the stock market that would tend to favor a Trump victory. And his numbers have improved in the polls recently. But I think the bond market's also telling another story, which is at the front end of the yield curve was pricing in more aggressive Fed rate cuts than we thought was reasonable, but also the growth backdrop has improved. So we've seen a bit of a bear flattening of the curve over the past, call it, month or so. I think that move higher in yields is more about a growth pickup than it is about anything related to necessarily concerns about inflation. So if we get inflation leading to higher rates, then I'm concerned. But at a call it 415, 420 yield on the 10-year, that's looking more attractive. Yeah.
So you don't think actually what the bond market is saying is Trump winning?
I think this is much more about the growth backdrop. I think the election outcome is very much a secondary factor because let's face it, the polls are still very tight. This can go either way. The battleground states, 4 of them are within a percentage point. So this is not an election that has been decided. We still have, as you know, a couple of weeks to go. Because of that, it would seem unlikely that the bond market and the equity market would be pricing in today a more complete picture of how this election is going to unfold.
But as Jim Caron was saying, whether or not it's Harris or Trump, it could be inflationary. With Trump, you get tariffs, and with Harris, you get higher corporate taxes. Both of these could be very inflationary. Also, there's going to be tax cut for people like in the middle income. Why wouldn't the bond market just be pricing in that environment?
I think that's missing a big element of what we're seeing unfold in D.C. over the next administration, or at least the next 2 years, and that is constraints on government. So you think about the Senate and the House. If you get a united government, you are going to have very narrow majorities. And the prospects for divided government under Harris are quite high because the Senate looks very likely to shift Republican. So when it comes to all of the policy prescriptions that have been put out on the campaign trail, not a lot of them are going to get done. I think when it comes to personal income tax cuts and extending those, we'll probably get most, if not all of them. But on the corporate tax side, when you think about the current state of deficits and the debt load, adding another tax cut in the case of Trump is going to be hard to do with the fiscal hawks. And if you have divided government under Harris, well, I mean, then that's just a non-starter.
So if you don't think that what we're seeing right now in the bond market is a Trump trade, are you saying that the market is not going to price in some of those fears of higher deficits, higher inflation, et cetera, in the direct aftermath if Trump does win? In other words, could you see yields climbing quite significantly in the immediate aftermath?
Yes, there's going to be the knee-jerk reaction, as there always is. We could get a bear steepener of the yield curve in the event of a Trump victory. We could get the dollar appreciating quite a bit, even though it's already very expensive. So you think about some of those reactions, yes, but then I think the market's going to get back to what is the foundational elements of the markets that we're seeing today, which is that the economy is strong, that the Fed is cutting interest rates into the end of next year and maybe even further than that. We've had strong earnings growth. We think earnings growth is going to remain strong next year. Where are the concerns on a Trump victory? Yeah, sure, it's on tariffs. But then the question is how strong will they be? They get more stagflationary the more that tariffs are raised, but then that has sort of cycles back on itself. If it becomes inflationary and bad for the economy, then maybe that'll be a signal to the administration that they want to do a deal or make some kind of an adjustment.
Terry Wiseman was talking about how his key tell will be if the dollar weakens in tandem with yields going higher after this election. Do you see that as a possibility if international investors get concerned about the U.S. deficit?
Yeah, I mean, I still think that deficits and debt are more of a secondary factor. They're not showing up in influencing where the bond market is headed. The bond market's principal direction is coming from the macroeconomy. It's coming from the decline in inflation rates, the sort of trend rate of growth in the economy, or if you will, nominal GDP. I mean, we're sort of getting back there. I also think, though, that it's possible that the dollar could weaken, very likely, because it is so strong right now. So the longer-term view and what we tell our clients is keep with the long term. Keep the focus on your strategic portfolio weights. Focus on and make some tactical trades if you can that you think make sense. But for the most part, hew towards your strategic asset allocation.
Kurt, this was great. We've got to do it again soon. It's good to see you.
To it.
And before the election, 2 weeks to go. Kurt, thank you. Kurt Reiman there of UBS.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal, and the Bloomberg Business app.